Hi there and welcome to the next episode of Property Investing Insider. I'm Michael Beresford and this is Matt Lewison, the OpenCorp CEO. Thanks for joining us, Matt.
Thanks, mate.
Always good to have you in person. We've been talking a lot to our clients over the last 12 to 18 months around the window of opportunity. And the window of opportunity being the complete opposite to what we're hearing in the mainstream media right now, which is obviously based on our research process and our fundamentals. So the questions have started kind of coming in from clients, so we thought it'd be a good one to address today. Have we missed the window? What does the window look like? When's it going to be shut? We know it's closing. No one better in the business to answer that than you.
Yeah. Have you ever heard the term, no one rings the bell when the market's about to go off?
I have.
And I think that's really true right now. In fact, for the last few months, we've been seeing the median house price around Australia going up. In most capital cities now, it's going up. And just for clarity, because when we talk about median, we need to be really clear that we're not saying that that means house prices are all going up. What it means is that the composition of sales is changing. People at the top end of the market are starting to list their homes for sale and they're selling really quickly at auctions. So we're seeing that auction clearance rate that's really high. And again, when I talk about an auction clearance rate, I don't mean that house prices are going up because the auction clearance rate is high. I just mean that people are now transferring properties. It's like musical chairs. But what those two things lead to is house price growth. And it leads to house price growth because it creates a sentiment that house prices are on the way up. People's expectation or belief that because a median house price is going up, that means all house prices are going up, forces more people to jump into the market. And as more people enter the market, suddenly there's more demand competing for the properties. Now, right now, we actually have very, very low supply of established housing stock on the market. It's lower than last year. It's lower than the 5-year average. So we've got really low levels of stock, which again, kind of completely blows apart people's expectations where they think interest rates have gone up, the fixed rate mortgage cliff.
Everyone's
happening,
selling.
everyone's selling, well, they're not. It's got very, very low levels of stock and we've got a growing population. So people are really competing for house prices or for houses and it's starting to push that price up. And as sentiment continues to improve with the rising median house price, it reinforces it. The other thing that we've got going on right now is that we've got an incredibly tight rental market and rents going up at 15 to 20% in many areas. And as rents go up 15 to 20%, and the expectation is that they'll continue to go up at a very, very high rate for the next couple of years because there's fewer homes being built, then obviously people start thinking, how can I get out of this rental market? How do I stop this constant increase in rents? I'd rather be paying off my own mortgage. Now those people, those first home buyers or prospective first home buyers would normally go and build a new house.
Yep.
But they're not. We're seeing fewer housing approvals, fewer housing starts because of the media attention that's come from the high profile collapse of Porter Davis and a few other very, very low profiles or no profile builders. And that's not to say it wasn't painful for those builders and their clients, but a lot of the media attention has gone to contractors that people in the industry have never heard of. They're not big. They're made to sound bigger by the media, but in reality, there's always a lot of construction industry insolvencies. And so the media is giving this attention because of the inflation story, right? So this goes around in circles because people are scared of signing a building contract because of what they read in the media about this inflated concern of insolvencies. So because they're scared to sign a new contract and build a house, they're going to compete for an established house. So there's more people competing for those established houses, pushing up the price and creating that bidding tension. And again, that reinforces that sentiment. Sentiment has started to pick up on people's expectation of house prices. We've seen it in the last couple of months, starting to edge up a couple of percentage points. And we're seeing that median house price growing by 1% a month thereabouts. So we're expecting that over the next 12 months, there's going to be areas that are going to grow by 10 to 15% in the median house price. And they're going to be the areas that are the most affordable, well located with very, very tight vacancy rates, where those first home buyers that would have otherwise built a house are now trying to buy an established house. And we're seeing that they're starting to pay a premium for an established house. So they want to jump the queue. They don't want to take any risk or take the 12 months to have a house built, or if they sign a contract, wait for settlement, build a house. They want to jump that queue. So they'll pay a convenience premium, we call it.
Yep.
And when they start paying that convenience premium, we saw this 10 years ago as well, people would pay a massive convenience premium. And it means that when you sign a contract and you do build a house, you make a profit just from having built it. So has the window closed? The window hasn't closed, but the window is absolutely closing, and no one's going to ring a bell when it's shut.
Yep.
Now there's two different windows. So that's the window of the property market cycle and the chance to get in before things really take off. Because if you wait until they've taken off, essentially it's like leaving money on the table, throwing money down the drain and giving it to somebody else who's going to capture that growth, and you're going to be paying more for that property. And we've modeled it, if you wait a year and you miss out on that first $50,000 to $60,000 of growth, you actually miss out on $100,000 over 10 years.
Yep.
Because you're paying a higher mortgage, you're paying higher stamp duties, and you're missing out on growth for a year to 2 years as well.
And 15 to 20% rental growth.
And 15 to 20%
based on
rental growth.
On the rental crisis. Yeah.
So absolutely, that window is closing. No one's going to tell you that when it's shut. So the sooner you can get in, the better. The other window is your personal window. And this is something that I think people overlook, is that personal circumstances change. Sometimes, and again, there's never a perfect time to buy an investment property, but certainly when you have kids, you have another kid, then there might be other things. You go, well, the kids are out of the way and I can start focusing on our investments. But then suddenly the kids are at school and maybe more costs start to happen and your focus starts to shift for spending time at sports or their other activities. Now you're paying for camps. So over time, like over your life, the window changes. I was really fortunate that I got into the housing market when I was still living at home. I had no living expense other than what I paid to my mum, which was nominal. And then I bought my second property when I was living in a rental house, and my third and the fourth, and I was sharing with 3 other people paying a quarter of the rent. If I was paying the full rent, as I was when I was 26, it would have been really hard to get in. My window changed, and I guess those living expenses change constantly. And if you're waiting for the perfect time in your life to invest and the perfect time in the market to invest, well, your window is exceptionally small and your margin of error is non-existent. And if you mistime that, you can be shut out. So if you can afford to invest now, and we know that the window is still open, but it's closing, then obviously taking action and putting one foot in front of the other and starting to take those steps towards growing your investment portfolio, whether that's starting or adding to it, is really critical. Because otherwise, as I said, you're leaving money on the table for somebody else to take that growth, or to use a better term, you're throwing it down the drain, and we'd much rather it be in your pocket.
100%. Yeah, I think the other key thing, we hear a lot about interest rates, inflation. We obviously look at the fundamentals. Over and above the fundamentals, including consumer sentiment, it's really important to remember that the banks and lending policies play such a massive role in the amount of demand and what people can borrow. You know, we're hearing, it feels like we're hearing every first Wednesday of the month, right? How much the borrowing capacities came down as a result of the recent interest rate rises month on month. What we're starting to see, and we were talking about this probably 2 or 3 months ago, was that we expected to start to see, as bank volumes drop, that they would become more flexible. And we've already seen in the marketplace, one lender has come down to a 1% servicing buffer. We expect others to follow. A bit of inside mail is that we expect another to drop down to 2%, from the standard 3% that it's been at for the past few years. And so these little signs, around the increase in sentiment, the increase in activity, more buyers coming into the market. Absolutely, the window's not shut, but it's not wide open. That's for sure.
100%.
Cool. Well, there's this week's episode of Property Investing Insider from Michael and Matt at OpenCorp. We hope you enjoyed it, and we look forward to seeing you next time. Bye for now.